Hey everyone, we all see what's happening with AI. You look at a chart of Nvidia and it's hard not to feel one of two things. Either you're thrilled you got in early or you're kicking yourself thinking you've completely missed the boat. The headlines are everywhere, the gains are astronomical, and every time you look, the obvious AI stocks just seem to get more and more expensive. It's the classic investor's dilemma. You know, this is the next massive technological shift, maybe the biggest of our lifetimes, but you're paralyzed, afraid of buying the absolute top. But what if I told you that AI revolution isn't just in the ninth inning? What if we're barely in the first or second? The mainstream media loves to focus on one or two superstar companies, but the truth is AI is not one thing. It's an entire ecosystem, a new foundation for our economy, and it requires a complete overhaul of everything from software to hardware to the very buildings that house the technology. The market, in its rush to find the next Nvidia, is overlooking some absolutely critical players that are just now hitting their stride, companies that are blowing up, but when you look at their future potential, are still incredibly cheap. In this video, I am breaking down my top 5 AI street stocks that fit this exact description. These aren't the ones everyone talks about every single day. These are the companies that are providing the essential tools, the infrastructure, and the platforms that make the entire AI revolution possible. And as always, this is my deep dive analysis, not financial advice. My goal is to give you the data and the thesis so you can do your own homework. Let's get into it. Outright. Let's start with a name that everyone loves to debate, a stock that's both controversial and, in my view, deeply misunderstood: Palantir, ticker PULTRA. For years, Palantir was this mysterious company operating in the shadows, working primarily with government agencies like the CIA and the Department of Defense through its Gotham platform. The commercial side, Foundry, was growing, but it was slow, complex, and expensive to deploy. The market correctly saw it as a lumpy, project-based consulting company, and the valuation reflected that. Then AI exploded, and Palantir, which has been doing AI and large-scale data modeling for 20 years, was perfectly positioned. Their key innovation is the Artificial Intelligence Platform, or AIP. This isn't just another AI model, it's an operating system for AI within an organization. Think about it. A large bank or hospital can't just plug their sensitive, private data into a public model like ChatGPT. They need a secure internal platform that can manage all their different data sets, connect them to various AI models, and allow their employees to actually use this power to make decisions, all while maintaining perfect security and data governance. That is what AIP does. It's the how. So why is it blowing up? The speed Palantir's old model was slow. The new model is all about AIP. They go into a company for 1 to 5 days, hook up their data, and show them immediate results. This has completely changed their sales cycle. Their US commercial customer count is exploding, growing at a rate we've never seen from them before. Their latest earnings reports show the commercial revenue is accelerating and is being driven almost entirely by demand for AIP. They are successfully making the transition from a government contractor to a commercial platform-based software company, and the market is just starting to see that pivot. Now, why is it cheap? I know what you're going to say. You'll look at the forward price to earnings ratio and it looks astronomically high. You'll tell me I'm crazy, but you cannot value a company like this on trailing earnings. You have to value it on its total addressable market and its potential for market capture. If you believe that every major corporation and government in the world will eventually need an OS for AI, then Palantir is one of the only companies on earth building a true end-to-end platform for it. If they capture even a small fraction of this market, their current valuation will look like a rounding error. It's cheap in the same way Amazon was expensive in 2001. You're not betting on next quarter's earnings, you're betting that they will become a fundamental foundational layer of the new enterprise it stack. It's a high-risk, high-reward play, but if the thesis is right, the upside is enormous. Let's move from pure software to the essential hardware, but not the hardware you're thinking of. My second pick is Micron, ticker MU. When people think of AI chips, they think of GPUs, the brains, but those brains need to be fed data at an impossible speed. That's where memory comes in. Micron is one of the world's top producers of DRAM and NAND, which are memory and storage chips. For decades, this has been a brutal, cyclical commodity business. Prices go up, prices go down, and the stocks swing wildly. But AI is changing the game. The AI angle here is one critical acronym, HBM, or high bandwidth memory. HBM is a completely different beast. It's a type of ultra-fast DRAM that is vertically stacked and connected directly to the GPU on the same package. You simply cannot have a high-performance AI chip like an H100 or a B200 without HBM. It is the bottleneck. If the memory is too slow, the billion-dollar GPU just sits there waiting for data. Why is it blowing up? Because the demand for HBM is non-negotiable and it's exploding. Micron is one of only 3 companies in the world that can produce HBM at scale alongside Samsung and SK Hynix. It's an effective oligopoly, and Micron's latest HBM3E product is best in class and is being snapped up by Nvidia for its next generation chips. The key here is margin. HBM is incredibly complex to manufacture, and as such, it sells for 3 to 5 times the price of standard DRAM. It's also eating up manufacturing capacity, which is tightening the supply for all other types of memory, like for PCs and smartphones, which is also driving up prices. Micron is at the very beginning of a massive upcycle, but this time it's not just a cyclical recovery, it's a new structural high-margin tailwind from AI. Their HBM is reportedly sold out for all of 2024 and most of 2025. So why is it cheap? Because the market still treats Micron like a dirty, cyclical commodity stock. You look at its valuation relative to other semiconductor companies, and it trades at a massive discount. It's valued on its price, to book or a low cycle forward P/E. The market is not fully priced in this structural shift. They see an old world memory company, not a critical AI enabler. Analysts are scrambling to raise their price targets, but they are still, in my opinion, behind the curve. They are underestimating the profitability and stickiness of HBM demand. You're getting a company at the heart of the AI hardware. Boom for a valuation that still reflects its cyclical past. That, to me, is the definition of cheap outright. We're 2 stocks in and we're just getting warmed up. We've covered the AI operating system and the high-speed memory. If you're getting value from this deep dive analysis, and I mean a real breakdown, not just a surface level list, do me a quick favor and hit that like button. It takes a second, but it tells the YouTube algorithm that we're delivering real value, and it helps the channel more than you know. And if you want to make sure you never miss a breakdown like this, go ahead and hit that subscribe button and turn on the bell. You won't regret it. Okay, my third pick is a true picks and shovels play. This company is a perfect example of selling the tools for the gold rush. The company is Vertiv, ticker VRT. Most people have never heard of them, but they are absolutely essential to the AI build-out. Vertiv provides critical digital infrastructure and services. What does that mean? It means power management and, most importantly, thermal management. They sell the boring stuff, uninterruptible power supplies, power distribution units, and advanced cooling systems for data centers. Here's the AI angle, and it's simple. AI servers are power-hungry monsters. An AI rack with multiple GPUs can consume 50, 70, or even 100 kilowatts of power. A traditional data center rack might only be designed for 10 kilowatts. On top of that, all that power consumption generates a massive amount of heat. You simply cannot cool these new AI racks with traditional air conditioning. It's not physically possible. You need advanced cooling solutions, specifically direct to chip or immersion liquid cooling, where liquid is piped directly to the processors to draw the heat away. And who is a global leader in these exact solutions? Vertiv. Why is it blowing up? Because data center operators from Amazon and Google to all the co-location providers are in a panic. They must upgrade their facilities to handle handle this new AI hardware, or they will be left behind. Vertiv's order book is exploding. Their backlog is at record highs. This isn't optional spending for their customers. It's essential. For every dollar spent on an NVIDIA GPU, multiple dollars have to be spent on the surrounding infrastructure to power and cool it. Vertiv is a direct derivative play on the growth of AI hardware. The demand for GPUs pulls demand for Vertiv's products, and that pull is just getting started. So why is it cheap? This is a stock that's had a massive run in the last 2 years. I'm not going to hide that. You're not finding a hidden gem in the bargain bin, but cheap is relative to growth. The market is still underestimating the duration and scale of this infrastructure upgrade cycle. We are not in inning 5. We are inning 1 or 2 of a multi-year, maybe decade-long build-out. Analysts have been consistently wrong about this stock, and they are still revising their earnings estimates upward quarter after quarter. The stock looks expensive on a trailing basis, but on a forward basis, it's just trying to catch up to its own growth. The thesis here is that the total addressable market for liquid cooling and high-density power is far larger than anyone currently models, and Vertiv, as a market leader, will capture an outsized share of that new demand. It's cheap relative to the massive, underappreciated infrastructure wave that is just now forming. My fourth pick stays right in the same neighborhood, infrastructure, but we're moving from the equipment inside the data center to the building itself. The company is Digital Realty Trust, ticker DLR. As the name implies, DLR is a REIT, a real estate investment trust. They are one of the largest and most established owners, operators, and developers of data centers in the world. They are quite literally the landlords for the cloud. The AI angle is obvious. AI needs data centers, lots and lots of them, and not just any data center. It needs massive, high-density, power-rich facilities. The demand for data center space, or megawatts, is at an all-time high, and supply is critically constrained. Vacancy rates are at record lows, and lease prices are climbing for the first time in years. Hyperscalers like Meta, Google, and Microsoft are leasing space faster than companies like DLR can build it. Digital Realty is on the front lines, providing the secure, powered, and connected shell where all this AI magic happens. So why is it blowing up? The story here has 2 powerful parts. First, you have the AI demand driver, which is creating a land rush for data center space. This gives them pricing power and a clear development pipeline for years to come. But second, you have the financial driver. As a REIT, Digital Realty carries a significant amount of debt to build its properties. For the last 2 years, as the Federal Reserve raised interest rates at a historic pace, REITs got crushed. The cost of their debt went up and their stock prices went down. DLR was no exception, but now that massive headwind is stabilizing and in the future could even become a tailwind as rates level off or decline. So you are getting a company that is benefiting from both a massive new structural demand and a recovery from a cyclical trough interest rates. And that's why it's cheap. The market has been slow to re-rate DLR. It's been valued as a slow growth, high yield, value utility real estate play. It has not been valued as a core growth infrastructure company that is a direct beneficiary of the AI boom. It's trading at a valuation based on funds from operations, or FFO, which is the REIT equivalent of earnings, that is still far below its tech peers and even below its own historical highs, despite having a more powerful growth driver than ever before. Plus, as a REIT, it is legally required to pay out most of its income as a dividend. So you get a solid, reliable dividend, a rare thing for a stock that is blowing up while you wait for the market to fully appreciate its new role as a fundamental piece of the AI revolution. Okay, my fifth and final pick is a true giant that's been hiding in plain sight. It's a company you definitely know, but you probably don't think of it as a primary AI play. The company is Broadcom, ticker AVGO. People traditionally know Broadcom as a diversified semiconductor company. They make the Wi-Fi and Bluetooth chips in your iPhone. They make networking hardware for enterprise. And they've made a series of massive software acquisitions, most recently VMware. But here is the AI angle, and it's twofold. First, and most importantly, is their custom silicon business. This is their crown jewel. While Nvidia sells general-purpose GPUs to everyone, hyperscale companies like Google, Meta, and Microsoft are also spending billions to design their own custom AI chips or ASICs to optimize for their specific workloads. Google has its TPU, Meta has its Meteor, and so on, but designing and manufacturing these state-of-the-art chips is unbelievably complex. Who is their number one partner in the world to co-design and deliver these custom AI chips? Broadcom. This is a massive, high-margin, sticky business that is pure AI. They are essentially the arms dealer for the hyperscalers who want to build their own weapons. The second angle is AI networking. An AI data center isn't just a bunch of GPUs in a box. It's a cluster of tens of thousands of GPUs that must be connected with incredibly high speed, low latency networking to work as one giant supercomputer. Broadcom is a dominant, if not the dominant, player in the high-speed Ethernet switches, optics, and networking silicon that makes this all possible. As AI clusters get bigger, the networking component becomes more and more critical. So why is it blowing up? Because their AI-related revenue is exploding. Their CEO, Hock Tan, has explicitly stated that AI-related chip revenue is growing at a staggering pace and will represent a massive multi-billion-dollar part of their business, far larger than analysts had predicted. Add to this the acquisition of VMware, which instantly makes them a powerhouse in enterprise software, generating enormous, stable, high-margin cash flow. This cash flow then funds their R&D and their generous, growing dividend. And that's the cheap thesis. How can a stock with a share price this high be cheap? Again, it's not about the absolute price, it's about the valuation. Broadcom trades at a forward P/E ratio that is significantly lower than Nvidia, AMD, Marvel, or other pure AI plays. The market still values it as a diversified, semi-conglomerate, not as the AI powerhouse it has become. It's being valued as part boring software, part cyclical semis, while the market ignores that its custom AI chip division is one of the most valuable and fastest growing AI franchises on the planet. You are getting a best-in-class AI custom chip designer and the dominant AI networking provider for the price of a legacy tech company, and you get paid a massive growing dividend while you wait for the market to wake up. So there you have it. 5 different ways to invest in the AI revolution, and not one of them was the obvious name. We have Palantir for the AI operating system for the enterprise. We have Micron for the essential high-margin HBM memory that feeds the GPUs. We have Vertiv for the critical power and cooling infrastructure, the true picks and shovels. We have Digital Realty for the physical real estate that will house the AI factories. And we have Broadcom, the hidden giant in custom chips and high-speed networking that ties it all together. This just proves that the AI revolution is an entire ecosystem. You don't have to bet on just one company. Often, the smartest investments are not in the gold miner, but in the companies selling the picks, the shovels, the maps, and the land. These are companies with massive tailwinds, clear growth, and in my opinion, valuations that do not yet reflect their critical role in the defining technology of our generation. But that's just my analysis. Now, I want to hear from you. What AI stocks are on your watch list right now? Are there any cheap gems that I missed? What's your take on these 5? Let me know your thoughts in the comments section below. I read every single one, and that's where we all learn. Thanks for watching. I'll see you in the next one.